Okay, so we're going to pick up the liabilities chapter. And so I'm going to cover some of the topics that are important about liabilities. There's really not very much coverage about short-term liabilities in this chapter. It's mostly about the long-term liabilities, specifically bonds, but I just need to talk to you just a little bit about current liabilities first. Okay, so normally current liabilities includes the very common thing that we have been studying about, which is accounts payable, just normal trade debt. And then the other thing we talked about some so far is the current portion of the long-term debt. So if you have a note payable, it'd be the part that's due within the coming 12 months. And so that would be the current portion that is included in the current liabilities as well. And then the third one would be a short-term note payable, a note for less than 1 year. And so the short-term note payable, we haven't really discussed, but it could be just where you turned an accounts receivable into a note payable because you were having trouble paying for all your accounts payables on time. So you agreed to pay interest with it and converted it to a note payable because of that. Or you could borrow money for a short period of time from the bank, like for cash flow and that sort of thing. And but either one of them would still be shown in the short term, all within the current liabilities because they're short term. I've got the journal entry there. When you issue a transfer between accounts payable and note payable, it's similar to when you convert an accounts receivable into a note receivable, but it's just, if you have an accounts payable, of course, it's a credit balance account. So when you convert it to note payable, you debit the account, credit note payable, and then at a maturity for that, you would just clear the note payable with the debit, and you would credit your cash that you're paying out for interest plus the principal, and then you would debit the interest for however much it was included. When you're borrowing for that short period of time, same thing, except for you're getting cash at the time that you sign the note. So you debit cash, you credit the note payable. When it's time to pay, same deal. You clear the note, you debit the interest expense, and you credit cash. All right, so then to bonds, this is the big one that's in this chapter that we have to get to where we understand. There's two ways basically that you can finance your business. You could issue stock, and that's equity, and we'll be talking about that a good bit in the next chapter, in the equity chapter. But then the other way is through debt, and through debt, there's two kind of principal ways that people raise funds through debt. And one is issuing bonds from the corporate bonds. And the second one is borrowing money from banks. So borrowing money from banks is pretty straightforward. We already dealt with that a lot this term, but this is our first exposure to issuing bonds. And that's a little more tricky, to say the least. Okay, so there's some things you need to know about bonds. One is they will have a face amount, and they a lot of times come in $1,000 increments. So it'll be a $1,000 bond. So if someone buys $100,000 worth of bonds, they're actually buying 100 bonds that are stated as 1,000 each. It could be different denominations, but usually it's a $1,000 bond. And usually it pays interest semi-annually, which just means they're going to pay interest twice a year. There's going to be a stated rate, which is also known as the contract rate, that's printed on the bond. That says this is how much we're going to pay for interest. So printed on the face of the bond, let's say it's 7% we're going to pay in interest. So that would be a good rate these days. If the contractor's stated rate is 7%, and if that's the same as other people are offering, which means it's the same as the market or effective rate, then the bonds would sell for that exact $1,000 that's on the front of the face of the bond. So if the amount we're paying is exactly equivalent to what this individual that's buying the bond could get on the open market from some other bondholder or bond issuer, then that would sell for its retail value. Retail and face would be equivalent. So in that case, you just debit cash whenever you sold a bond for the amount that you sold them for, the face value, and you credit bond payable. So that just never happens, honestly. I mean, it's possible that it could happen, but it's just not very likely because fluctuations in bond rates happen every day, even multiple times a day. So there's not a lot of likelihood that you would issue it for exactly its face amount. So that leaves us with, well, then what do we do? Okay, we're going to talk about the market rate or the effective rate. When the face amount that's printed on our bond, which is equivalent to the amount that interest is actually going to be paid in cash each 6-month period, well, or if it's on an annual rate, it'd be each year. The amount, that percentage, is the annual rate that's going to be paid in actual interest payments. So if the face of the bond or the interest that's going to be paid is higher than the amount that others will pay, then that makes the bond more valuable. So if the face of the bond, though, is lower than what the market is paying or what others are offering for bond interest, then that means that we're going to have to sell it for less than its face amount because it's less valuable. So here's an example. If the face amount of our bond is 7%, now if you have the going rate of other people are issuing bonds for, other companies are issuing bonds for, is 7.5%, then all of a sudden when someone looks at our bond and that 7.5% bond, they would pick the 7.5% bond every time, because why not take one that'll get more interest? So that bond that we have has to be sold at a discount to compensate for the fact that we're not paying as much as some of the other people that are offering a higher interest rate. So what we would have what's called a discount on the bond when we issue the bond. So what would happen is we'd debit cash for the amount we issue it for. We would credit the whole bond payable for the face amount, and then we'd have a debit for the discount that we had given because that bond was paying a lower interest rate. So the debit to cash is for the issue price. The credit to bond payable is for the face amount. And that in between, or actually the balancer on the journal entry when you're making it, is the difference between the two, and it is the discount on the bond. Okay, so that's one thing that might happen. We might sell at a discount. And the next thing that might happen is we might sell at a premium. If our bond is paying 7%, but the market has a little shakeup and the other bonds are paying less, like 6.5% maybe, our bonds would sell for a premium because people would want to get the higher interest rate that we're offering. So if you had $1,000 bond, the face amount is $1,000, and you're getting a premium on it, you would add that to your bond amount, and the issue price would include that premium. So when you did that journal entry, you would debit cash for the issue price, which would be higher than your face amount this time. You would credit the bond for just the face amount. And then the equalizer to make the two sides of the entry balance would be a credit, because this is the premium. And then you would put that to the account premium on bonds payable. Here's one other thing we didn't talk about as I was going through here. When you are selling a bond for a premium or a discount, you might say, we issued bonds at, and for instance, on the discount, we issued bonds at 98. That means we issued them for 98% of their face amount. So if it were $100,000 worth of bonds and we issued them at 98, that means we issued the issue price, or the cash we got, was $98,000. $100,000 times the 98. Bonds issued at 98. So if it was 50,000, then bonds issued at 98. Oh, what's that going to be? 49,000 of the 50 would have been the cash we got from it. And then for the premium, if we issued them at 101, it means that we sold $100,000 worth of bonds for 101,000, and then the premium is 1,000. So if anything 100 or more is a premium, anything more than 100 is a premium, and anything below 100 is a discount. So you just need to use that terminology. Bonds sold at 107 are sold at 107% of face value. So now the next thing we have to figure out, sorry, I got a phone dinging on me. All right, so the next thing we have to consider is the time value of money that's related to bonds, because there's a way to calculate what should the bond sell for today, because you can't just arbitrarily say, oh, they're paying 0.5% more interest than us, so how much should we discount it? You need to calculate what the real value of the bond is based on the current present value or net present value of the payments that are going to be coming back to the bond holder. And so one way to think of that is just all about time value of money. And so I don't want you to freak out and think this is something complex, because it's not. Time value of money is not complicated. It's just a matter of everybody's not been exposed to it. So it seems so foreign to a lot of people that haven't looked at it before. But think of it like this. Let's say I came in, I mean, this is a little out there, I know. Let's say I came into class one day and I said, you know, I have something I want to sell. In the past, I've told you about selling king cakes. And, you know, I told you that I really can't sell things to students. And that's true. But I do pretend that I could sell so I can get a point across. So I'm going to pretend that I could sell something to you guys if I had something to sell and if it wasn't against the rules for me to sell things to you. So let's just say I came in to the classroom one day and I said, you know, I need to get a new dirt bike. I know I don't really have a dirt bike, but if I did have that hobby and I needed to get a new dirt bike and I had an old dirt bike, I'd say, I need to get a new dirt bike. And I was wanting to sell this old one. And it's a really great bike. And I paid a lot of money for it, but I'm willing to sell it for $1,000. It's a really good bike. And so you can really like de-stress by riding trails whenever you're stressed out about school or about work or whatever personal things. But anyway, riding is a really great hobby to have. And so, okay, so I've convinced you guys that this is a great thing to have. And so, but I said, but I need to have, I need to get, $1,100 for this bike, or I'll take 1,000 if you only have 1,000. And so one student came along and he said, okay, yeah, I've got $1,000 and I really need that bike because I am totally going crazy trying to keep all this schoolwork under control. And the stress is just freezing me up. I can't get anything done. I said, okay, great. Well, then where's your $1,000? I'll bring the bike and meet you with it to trade off. And he's like, well, no, that's the thing. Dr. Weber, I don't really have cash right now, but I have this cash that's going to be available at the end of next year. And so at the end of next school year, I'm like, oh, well, that's not the same thing. I was needing to get the cash today so I could give you the bike. He's like, well, see, I need the bike now, but I'm not able to give you the cash yet until next year. And so I was like, oh, that's not quite right for me. Because if I get the cash today, I can just start earning interest on it. But if I have to wait a year, that's going to be a lot different deal for me. Because here's one. If I had $1,000 today and I could say get an increase of 10% by like putting it in the stock market or something, then I would have by the end of next year, I would have $1,100. And then by the end of the next year, if I added 10% to that balance, I would have $1,210. So if I have $1,000 today, that's not the same equivalent as if I wait a whole year to get $1,000, right? And that's what the time value of money is all about. So what we have to do with these bonds to figure out what the bond really should sell for is we can't just look at, well, that's no worries. They're going to get all of their principal back. But sometimes they have to wait 30 years to get it if it's a 30-year bond. Or if it's a 10-year bond, they have to wait 10 years. They get the full principal back, yes, but they have to wait a long time for it. So if they have their money right now, instead of waiting 10 years or 30 years, they could earn interest, or they could earn an increase in value from the stock market. They could increase their investment, in other words. So they have to figure out, we have to decide what the market rate is. The problem's going to have to give it to you, by the way. And that we're going to use that market rate to decide how much is this initial, how much is that, not the initial amount, how much is this bond that's going to pay out at the end going to be worth today if we discount it back to today's dollar. So we're going to take the market rate and go to a table to find a factor that's going to help us decide what is the value of this bond today. And so we're going to practice some of those. But first, I just want to give you the broad concept. To come up with the selling price of the bond, though, we need the present value of that lump sum payment that's coming at the end. So if it's a $100,000 bond, the bond holder is going to give us the $100,000. We're going to give them the bond, and then we're going to pay them back at the end of the bond period. But we need to figure out how much it's worth today, the fact that we're going to pay them back a long time from now. And we're going to add to that the present value of this stream of interest payments that is going to be coming to them every 6 months in the meantime, because that certainly is worth something too. And so we're going to present value that interest and then add it to the present value of the maturity value. And that's going to tell us what the bond should be issued for. So we'll work on these and try to come up with some, I have some examples where I can show you what the bond calculation will be, the price of the selling price of the bond. A lot of these problems they give you, they just tell you what the selling price of the bond is, and you just show it as a discount or a premium based on what they tell you they issued it for. But I want you to see how it works. So I'm going to do another example another video that's going to show you how to calculate the present value of the bond with discounting the stream of interest payments plus discounting the maturity principal balance so that you can add them together and come up with what should this bond sell for. All right, but I'm going to use this very methodology that I have here on this note sheet. All right, and so then we're going to amortize the premium or discount based on the effective interest method. And we're going to have some exercises to do this as well. And that is going to be part of that same video, because I don't actually have a great exercise in this in the Openstax that I'm using, but I do have some exercises in Openstax, but it's just not the ones I want. So I'm going to do a separate video with that effective interest calculation for the price of the bond and the amortization of the bond. We are skipping in this chapter the part about bond redemption, contingent liabilities, straight line amortization, simplified effective method, and installment notes. And that the reason we're skipping some of that, this middle piece, is simplified and the straight line, is because we're using effective method. And so that's why I'm having to pull in some more examples, because the textbook talks about the straight line amortization, which is not actually what most people do in practice. Okay, so I'm going to pull that. I'm going to pull some for that. But for now, we'll do some of these Openstax, and these are coming from the Openstax chapter 13. So the first one says EA2, Beluga Inc. issued 10-year bonds with a face value of $100,000 at a stated rate of 3% when the market was 4%. Interest was paid annually. In this case, it said annual, not semi-annual. The bonds were sold at 87.5. What was the sales price of the bond, and were they issued at a discount or a premium? So first thing, you know already when you see a stated rate of 3% and a market rate of 4%, you know that our bonds are not paying adequately. We have to sell them at a discount. So, and then the second way you know we sold them at a discount is you see that we sold the bonds at less than 100. That means less than 100% of their face amount. So two ways you could look at it and see that they were sold at a discount. So 87.5% is what we sold. We sold them at 87.5 of their face amount. So $87,500 was the amount we issued them for. And they were sold at a discount. Okay. EA4, on January 1st of 2018, Wauwatosa issued 5-year bonds with a face value of $200,000, a stated interest rate of 12%, to be paid semi-annually on July 1 and January 1st. The bonds were sold to yield 10%. Assuming the bonds were sold at 107,732, what is the selling price of the bonds? So what they're telling you is the market rate or effective rate was 10%. And so we know that if we're paying 12 and the market rate is 10, that we're going to get a premium on our bonds because people would want them, and just supply and demand says people want our bond more, they will pay more. So it's sold at a premium. That's very obvious because the interest rate at the market is less than our interest rate. And the other way we know it's sold at a premium is it says the bonds were sold at 107.732. So that's telling you if it's more than 100, it was sold for a premium. So it was sold for 107.732, which is 107.732% of $200,000, which was the face amount of these bonds. So it was sold for $215,464, and sold at a premium because the stated rate is greater than the market rate. Now, this was the only thing that was strange about this one. They stated the market rate by saying the bonds were sold to yield 10%. That just is another way of saying that's the effective rate, also known as the market rate. Okay. EA7, on January 1st, year one, Foxcroft issued 100 bonds for a face amount of $1,000 for $104,000. The bonds had a stated rate of 6% and paid interest semi-annually. What was the journal entry to record the issuance of the bonds? Okay, so first thing you look at is you say, okay, they were sold $100,000 worth of bonds, sold for 104. That's obviously a premium, right? And so that's all we need to know. If we issued them for 104, that means cash was 104 that we received. The bond payable was 100 because that's the face amount. And the difference between them is what we need to balance the entry, a $4,000 credit. Since it's a credit, we know it's a premium. But the other thing we can see is that we know if we issued $100,000 worth of bonds for 104, then we have a premium situation, right? Okay, so that's this. Again, here's a link to the Openstax textbook and the exercises at the end of the chapter. I'm going to leave it at that for here, and I'm going to make us another video to discuss calculations of the selling price and the amortization of the based on the effective interest method.